Well, hello everyone. It's been a long time, and I think I'm back just today again to talk about something very interesting. First of all, I would like to, know that whether you're all safe and doing well, because the second wave of coronavirus is something which really problematic. And we should do our best to avoid it by in whatever ways we can, apart from just maintaining social distance, but also wearing a mask. I hope you're all doing well. The first thing is inflation targeting. So the whole topic today that we're going to talk about in brief is going to be inflation targeting. Now, what is inflation targeting? As the term indicates, it's essentially setting a target that inflation should not go beyond a certain level, either upwards or downwards. So you can't have a very low level of inflation, nor can you have a very high level of inflation. So you should have some balance, and it should be somewhere in between. So now this experience of inflation targeting has been tried and tested in various other countries. This whole trend began right from the 90s, I would say, and the logic actually goes to what is appearing as a policy proposal from Milton Friedman. Everybody knows that Milton Friedman was a monetarist and the father of what is known as modern monetarism, which included which was essentially seeking a primary role for the central bank of any economy. And he believed that central bank's main job was to control inflation. And thus, by controlling inflation, you could control a various other set of factors that are there in the economy. So, what is inflation targeting? In India, the whole logic came about because of post global financial crisis of 2008, which luckily did not affect India as much because of relatively less exposure to foreign capital, foreign money, etc. And domestic savings that India had protected it. Now, what is the inflation targeting logic that is being used in India? So, over the 2010, 11, 12 period, you have seen the data shows that the inflation levels were going beyond a certain amount, which was unacceptable to the masses. Because what is the negative effect of inflation? One might think of the positive effect in terms of a rise in prices and incentivizing producers and building up more demand. And this is also a result of growth. Now, what is the negative effect? There are many, because inflation if increases the prices of essential commodities, and that spirals down into a very different, in a very different fashion, which results in not just a rise in prices, but also a rise in cost for industries, and there's a lot of other negative production-related problems that will cause. Uh, and inflation as a whole is therefore an important metric to be monitored constantly, because it not only affects general price level, but it also affects a general economic scenario. So in this context, RBI was, first it started off with a rise in policy rates. So then the governor Raghuram Rajan tenure one saw a massive rise in the interest that was being levied on loans, and that would filter down into a higher cost of borrowing. What is the reason? Because the general economic theory and terms of monetary economics would say that to control inflation, the key thing that any central bank would do is to exercise a contractionary monetary policy. That means it would have to reduce the money supply in the country and in the economy. And this it would do through various means. One would be raising the policy rates, one would be raising the the reserve ratios, and also sometimes it will also be uh, selling government bonds so that the money from public will enter into the RBI. Now, what is the trend so far? In most countries which adopted this metric, it did not result in a very successive, controlling of inflation. Now, what then? Why then was that adopted in India? In India, it was basically a plan it was like a decision made through an act. Because it was not just a policy change, but rather it was statutory, move. It was a statutory move, that is in terms of by passing a law or an amendment to a law. It was There were sweeping changes made to the Reserve Bank of India Act and the Banking Regulation Act of 1949, which enabled the formation of a monetary policy committee, of which there would be 6 members in total. Out of the 6 members, 3 would be nominated from the Reserve Bank, there is a representative of the Reserve Bank of India, and the other 3 would be nominated by the Government of India through the Finance Ministry, etc. And the other, it set a price target, so it set an inflation target between 2% and 6%. That means, on an average, an inflation component or the inflation, the rate of inflation should not exceed to 6% and should not fall below 2%, because 2% and below or too low inflation would not be a very good figure, because that would indicate that there is a demand weakening and it would result in a lot of other negative consumer effects, producing supply effects. That means the price is not very much increasing. It's an indicator that there's not much growth happening. Now, 6% and beyond, we have seen that inflation in the last 5 years has been actually going up slowly. Now it has crossed 7%. Now, inflation is measured in 2 ways in India. One can be the wholesale price index, which includes cost of all goods and services produced at the wholesale level, and consumer price index. The consumer price index is essentially a basket of commodities which is essential for consumption across the board in the country. So you have your essential food items, oil, etc. All these form the consumer basket. And RBI has been occasionally shifting it, and now it was earlier the WPI or the wholesale price index, and now it's the consumer price index, which is used as a key metric for inflation. Now, what has gone wrong? The target for inflation was 6%. The upper limit was 6%, and the lower limit was 2%. So 4% was the maximum, the ideal inflation amount that was targeted. Now, though from first, when it was adopted in 2016, the inflation actually was around 2%, something like that, so around 2%. Now it went up beyond 4 and crossed 6. So what was the act that was amended say about this? What is the act saying about it is this: if the threshold is crossed, there is going to be accountability ensured on the Monetary Policy Committee, and in general, the nominated members who are monitoring all this, the Monetary Policy Committee, should sort of state the reasons why this target has not been maintained and what it intends to do. Now, why do I think this is not a good measure? I believe that it's not a very good metric, because inflation alone cannot be, the main metric that should be used for analyzing whether things are going bad or right. So, earlier on, the people would use the central banks across the world, and even now, a lot of economies do that. Is what is known to follow what is known as multi-indicator approach. So instead of focusing just on inflation, if we focus on also on growth and when banking, the system, the financial systems conditions, I would also focus on the growth of key sectors, which in turn drive the economy. So this way, overall, a holistic perspective is obtained if you use multi-indicator approach, and then you would know what would exactly target inflation, and I mean how to control inflation, because if there's a disproportionate amount of production happening in certain sectors, and that is resulting in excess supply and low demand, which would then drive up prices. And sometimes there is a glut, or there is sometimes excess demand in some sectors. So either way, less supply or extreme demand would result in a sort of a very inflationary scenario. So keeping this in mind, the government has decided to review it in the coming months. And the only problem there is it's not specific as to, you can't identify how fast can a policy impact inflation. So there are a lot of papers, and the most prominent one being a discussion paper by a former deputy governor of the Reserve Bank, Dr. Viral Acharya's report, a speech, excerpt from a speech, wherein he pointed out the research showed that there will be at least 36 months lag for a policy transmission. So if there is a policy that is adopted, a major policy, the impact would be seen only after 36 months after it's adopted. So that's 3 years. So now 3 years from 2016 will mean 2019, and now 2 years from then, 2021. So what we see is inflation is moderating, but it's still going up. So what should be done is ideally to focus not just on inflation, but you have to have a flexible inflation targeting, which is a major proposal point made out by not just a few experts, but a lot of other experts, including Dr. Ashima Goyal of Indira Gandhi Institute of Development Research in Bombay, which is a think tank of the RBI. She pointed out in a research paper that what is necessary is a flexible approach rather than a strict approach of 4% and not beyond. You should also have to keep in mind the other sector, the other uh, engines so far, or the other factors that drive inflation. So this is a important point that is being discussed in policy circles in this banking, in the field of banking in general, and then more so as to what to be done in India. Because the exclusive focus on inflation has from 2011, I would say, because only from then you had a hike in the interest rates, which resulted incidentally in controlling inflation, but actually drove up the cost of borrowing for small and medium firms. And this is evident in the, one should understand that it's not just formal sector, but to a large extent, the unorganized sector is what drives the Indian economy. And unfortunately, they rely a lot on, it's not just a few non-banking sector, but also on banks. So now banks raising the cost of the interest that is offered on loans is actually naturally going to impact or the loan portfolio that is created by a company. And thus, it would become difficult for them to repay the loan if the business is not doing well. So this is an ongoing process, and only time will tell whether it's actually going to make any difference or not, whether we adopt a flexible or a strong focused inflation targeting framework. But I would believe ideally, from what I have understood of the system, it is essential that you also have a holistic picture, so that you don't exclusively focus on only one metric and leave out the rest, because all the other metrics, including growth, unemployment, and also the financial condition that is there in a country's financials, in a country, is as important, if not less, as inflation. So keeping in this in mind, I hope this video was informative, and do like, share, and subscribe to my channel. Thank you.